If you give money to charity, or you're planning to, there's a good chance you're doing it the expensive way. Not because you're doing anything wrong, because nobody showed you a better way. And by the end of this video, you'll know exactly how to give the same amount to the same causes and potentially keep tens of thousands of dollars more for you and your family.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. So here's what most people do when they're feeling generous. They write a check. And there's nothing wrong with writing a check. It goes to the charity. They're grateful. You feel good. But here's what nobody tells you. The tax code actually rewards you for giving a different way. And if you don't know about it, you're essentially leaving your own money on the table. So let's walk through the 3 strategies that smart families use to give more to the causes they care about while keeping the tax code on their side.
Let's start what we call the appreciated stock strategy. And this is the one that surprises people the most. Say you bought a stock years ago, Apple or Amazon or Microsoft, for $5,000, and today it's worth $100,000. You've done really well. Now, at the same time, you decide you'd like to give $100,000 to your alma mater. Great. If you write a check for $100,000, it costs you $100,000 of after-tax dollars. They're straightforward, right? But what if instead you gave your alma mater the stock? Here's what happens. The alma mater, the charity, receives the full $100,000. But that stock only cost you about $75,000 or $80,000 had you accounted for the capital gains tax you will owe when you sell it. So the charity gets the same gift, but your effective cost, it just dropped by $20,000 or $25,000. Same generosity, same impact, dramatically different cost to you and your family.
And here's the part that really matters. You also avoid paying capital gains tax on that appreciation. If you sold the stock first and then wrote the check, you'd owe tax on $95,000 of gains. Depending on your tax bracket, that could be 15 to 20% or more if you're in a higher income range. By giving the stock directly, the tax bill disappears. The charity doesn't pay it either because they're tax exempt. The IRS built this into the tax code on purpose. It's not a loophole, it's an incentive. And yet most people don't know about it because nobody has walked them through it.
Now, you don't have to be sitting on $100,000 stock for this to matter. At $1,000 or $5,000 or $10,000 of appreciated stock, the math still works. And over a lifetime of giving, these savings could add up to something significant. The key is this. If you own something that's worth more than you paid for and you're planning to give to charity anyway, why would you write a check?
The second strategy is something called a qualified charitable distribution, a QCD. If you're over age 70 and a half and you have an IRA, this is one of the most powerful tools in the tax code, and it's wildly underused. Here's how it works. Instead of taking money out of your IRA and paying income tax on it, then writing a check to your charity, you direct the IRA custodian to send the money straight to the charity. The charity still gets the full amount, but that distribution doesn't show up as taxable income on your return. If you're wondering why your advisor never walked you through this, subscribe. This is the kind of strategy you should have heard about years ago.
Let me give you an example. I had a woman recently tell me she wanted to put her church in her will. She wanted to make sure they received a gift after she passed. It was very important, right? I asked her, have you ever considered giving it now rather than later? And she was about to turn 70 and a half, which meant she'd be eligible for a QCD in just a few months. I said, we could do this through your IRA in April. And she lit up. She said, I'd love that. I can see what it's used for, whether it's a stained glass window or a new pew, whatever it may be. Same gift, same generosity. But now she gets to see the impact during her lifetime, and she avoids the income tax she would have owed on that IRA withdrawal. And on top of that, it counted as part of her required minimum distribution when, if she were old enough. So sometimes thinking differently about your planning can make all the difference in the world.
And here's something most people miss entirely. A QCD doesn't just save you on income tax. It can also keep you out of higher Medicare premium brackets, what's called IRMAA. If your income crosses certain thresholds, your Medicare premiums jump, sometimes significantly. A QCD reduces your taxable income, which means it can keep you below those thresholds. So you're not just saving on income tax, you're potentially avoiding Medicare surcharges as well. Doesn't happen by accident. It happens when someone is looking at your full picture and coordinating all the pieces.
Now, here's the third strategy, and this one is perfect if you know you're going to give, but you're not sure exactly when or to whom. It's called a donor advised fund. Think of it as a charitable savings account. You contribute appreciated stock or cash into the fund, and you get the tax deduction in the year you contributed. But you don't have to decide which charities receive that money right away. The money sits in the fund, invested, growing, and over time, you direct grants to the organizations that you care about on your schedule, not the IRS's.
This is incredibly useful for people who have a year where their income is unusually high. You may have sold a business, you may have gotten a really big bonus, maybe a concentrated stock position needed to be unwound. You take the deduction when it helps you most, and then you distribute the gifts over time as you decide where they should go. It's a wildly underutilized tool. And when it's coordinated with the rest of your tax picture, it can be part of a much, much bigger strategy.
Let us show you what we mean by bigger strategy. We had a client who was gifted highly appreciated stock from his parents. There were a massive amount of capital gains built into these positions. And if he sold it, as he probably would have needed it at some point in retirement, he would have owed the capital gains tax, and they would have been enormous. So here's what we did. We gave the appreciated stock to his charity. They had a newspaper article about him and everything. They talked about, he was so pleased. His grin was from ear to ear. So the appreciated stock removed the capital gains exposure entirely from him and his wife, and it gave him a huge income tax deduction. What we did is we used that income tax deduction to offset Roth conversions in those years. So in one strategy, we eliminated the capital gains tax, funded his charitable giving, and converted nearly all of his IRAs to Roth, all at dramatically lower tax costs. We almost beat the tax man twice.
And here's the thing that matters for the long run. That Roth money now grows tax-free for him, for his kids, for his grandkids. So the charitable planning didn't just help this year's tax return, it created a multi-generational benefit. That's what we mean when we talk about your lifetime tax bill. Not just April 15th, the whole picture.
And that kind of move, it doesn't happen when your CPA, your attorney, or investment advisor are all working in separate rooms. It happens when somebody is coordinating the whole team. When there's a quarterback in a virtual family office like we have, or a personal CFO, looking at the full field, that's what you need. That's the difference between writing a check and having a strategy.
So let's bring it together. If you're charitably inclined, a lot of families are, there are three things to take away from this. First, if you own appreciated stock or other assets with built-in gains, consider giving those instead of cash. The same gift to the charity, much lower cost to you. Secondly, if you're over 70 and a half with an IRA, look into qualified charitable distributions. They reduce your taxable income, could possibly lower your Medicare premiums, and they're really simple to set up. Thirdly, if you want the flexibility to take the deduction now, only to give later, a donor advised fund might be exactly what you need.
None of this means giving less. It just means giving smarter. Generosity and tax intelligence aren't opposites. They're actually partners. And when you're coordinated with the rest of your financial life, your income plan, your estate plan, your income tax strategy, the impact just multiplies.
So if you're sitting there thinking, wow, nobody's ever walked me through this before, or maybe you're already giving, but you're not sure if you're doing it the most efficient way, be happy to talk. Click the link below to schedule a conversation. Because investing is the easy part. Coordinating the tax strategy around your generosity is far harder.
And here's something to think about. You just saw how the obvious approach to charitable giving, writing a check, might actually be the most expensive way to do it. What if the same thing is true about how you're saving for retirement? Most people assume maxing out their 401k and deferring taxes is the smartest move, but that assumption could be costing your family more than you realize. Watch this video next. It might change how you think about every dollar in your retirement account. Click here to watch.